Hi, today we'll take a look at another IFRS standard dealing with the groups and consolidation, which is IFRS 3 business combinations. It is closely related to IFRS 10, consolidated financial statements, so if you study this topic, I strongly recommend watching my video about introduction to the group accounts and another video about IFRS 10. You can find it right here in my website or in this YouTube channel. I am Sylvia, the founder of IFRS Box, and if you'd like to learn more about the consolidation and actually learn how to do it with lots of case studies, examples, and if you need to learn IFRS and you want to do it easily and with lots of fun, then you're welcome to check my web ifrsbox.com, my courses, quizzes, and many more. I would say that IFRS 3 and IFRS 10 supplement each other as both of them deal with the parent-subsidiary relationship and they just look at different aspects of it. So what's IFRS 3 about? The objective of IFRS 3 is to improve the relevance, reliability, and comparability of the information that a reporting entity provides in its financial statements about a business combination and its effects. Well, more specifically, IFRS 3 establishes principles and requirements for how the acquirer recognizes and measures the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. Then recognizes and measures the goodwill acquired in the business combination or a gain from a bargain purchase. We'll explain goodwill and non-controlling interest a bit later. And determines what information to disclose about the business combination. Well, first of all, let me tell you that in order to account for a business combination, assets and liabilities acquired need to constitute a business. Otherwise, it's not a business combination and an investor needs to account for the transaction in line with some other IFRS standard. The guidance in IFRS 3 says that the business can be acquired in many different ways and it needs to contain three basic elements to be a business. Inputs, which is any economic resource that creates or can create outputs when one or more processes are applied to it, for example, non-current assets or inventories or cash. Then element number 2, process or processes. Well, processes any system, standard, protocol, convention, or rule that when applied to inputs, it can create outputs. For example, management processes, workforce, production processes. And finally, outputs as the results of inputs and processes applied to those inputs that provide or can provide a return in the form of dividends, lower costs, or other economic benefits directly to investors or other owners. Well, if all three elements are present, then an investor acquired a business and needs to apply IFRS 3 for business combinations. Otherwise, investor might acquire just assets and apply own processes. In such a case, investor does not account in line with IFRS 3, but in line with some other standard applicable for the acquired assets. Well, how shall we account for business combination? IFRS 3 requires application of the acquisition method, which involves 4 steps. Step number 1, identify the acquirer or the buyer. I know it looks very straightforward, and in many cases it is straightforward, but sometimes it's not so clear. For example, you can deal with some merger when two companies merge together, and in such a case, you need to identify who acquires whom. In most cases, it will be the larger company. Or reverse acquisitions might make confusion too. It's when smaller company buys bigger company. Step number 2, determine the acquisition date. It's the date on which the parent acquires control over subsidiary and starts applying acquisition method. In most cases, it's the closing date, but it can be earlier or later. Step number 3, recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. In step number 4, recognize and measure goodwill or a gain from a bargain purchase. Well, we'll spend a little more time on steps number 3 and number 4. Let's take a closer look at step number 3. Recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. An acquirer or investor shall recognize all identifiable assets acquired, liabilities assumed, and non-controlling interest in the acquiree separately from goodwill. The important thing here is to recognize all assets and liabilities at fair value determined at the acquisition date. While a subsidiary can apply different measurement methods, such as costless depreciation, and therefore often fair value adjustments are necessary at consolidation. Sometimes subsidiary has some unrecognized assets or liabilities, and these need to be recognized too. What about non-controlling interest? Well, it's the equity in a subsidiary not attributable directly or indirectly to a parent. So it's that part of the subsidiary that belongs to someone else. Well, if a parent owns 100% share in a subsidiary, then non-controlling interest is zero because full subsidiary's equity is owned by the parent. However, if parent owns less than 100% share, let's say 80%, then non-controlling interest is 20%. A few years ago, it was called minority interest. There are two options or methods permitted by IFRS 3 to measure non-controlling interest. Method number 1, we can opt to measure non-controlling interest at the proportionate share of non-controlling interest on the fair value of the subsidiary's net assets. Or alternatively, we can measure it as its full or fair value, usually based on market value of the shares held by the non-controlling interest. Method 2 affects goodwill, by the way, because under fair value method, you're showing that non-controlling interest owns a part of that goodwill too. Well, if you'd like to revise the short illustrative example with numbers, please refer to IFRS 3 article on www.ifrsbox.com or subscribe to the IFRS kit, in which you'll find lots of related calculations and explanations. Step number 4, recognize and measure goodwill or a gain from a bargain purchase. Goodwill is an asset representing future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So let's imagine a parent buys 100% shares in a subsidiary. Parent pays 100,000 currency units for these shares in cash, and at the date of purchase or acquisition, subsidiary's net assets or equity was 80,000 currency units. Here we have a difference of 20,000 currency units, and this difference is nothing else than goodwill. In fact, there are more things to watch out when calculating goodwill. It's the excess of the aggregate or the sum of the following amounts: the consideration transferred measured in accordance with this IFRS, which generally requires acquisition date fair value, simply speaking, the payment for interest in subsidiary. Then the amount of any non-controlling interest in the acquiree measured in accordance with this standard. And finally, if a business combination was achieved in stages, we need to add the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. In our small example, the aggregate is 100,000 currency units. On the other hand, we need to look at the net of the acquisition date amounts of the identifiable assets acquired and the liabilities assumed measured in accordance with the IFRS 3. In this case, it's 80,000. Sometimes goodwill is positive and sometimes it's negative. The basic goodwill formula is fair value of consideration transferred plus non-controlling interest plus the previously held interest when subsidiary is acquired in stages, and we should deduct subsidiary's net assets. Now, as I mentioned, the result can be either positive or negative. So when the result is positive or greater than 0, then the difference is called goodwill. And as it's acquired in a business combination, a parent needs to capitalize it as an intangible asset and perform annual impairment review. But when the difference is negative or less than 0, it means then the parent paid lower amount for the subsidiary than its fair value is, and this is called negative goodwill or a gain on a bargain purchase. Well, first of all, you need to reassess the amounts at which the parent measured both the cost of the combination and subsidiary's net assets, because there might be some error and parent needs to be sure that there's really a negative goodwill. Secondly, if everything is okay, we need to recognize any excess or negative goodwill to profit or loss immediately. So we're not going to treat it like some liability, we are just going to recognize it to profit or loss. Except for these basic rules covered in this video, IFRS 3 contains also other rules and specifications that deal, for example, with the contingencies, cost of acquisition, acquisition achieved in stages, and many disclosures about the business combinations. So this was a short summary of the standard IFRS 3 business combinations. If you're interested in more detailed explanation of the group accounting or our case studies and examples teaching you how to prepare consolidated financial statements, well, then you're welcome to check out my IFRS kit or subscribe for free weekly newsletter at ifrsbox.com. Bye-bye, and thank you for watching.